This is the latest Movers and Shakers show, a monthly show where we try to look at the big moves within the indices, FX and commodity space and gauge whether we're going to see a continuation of that move and whether we're seeing strong trends or whether that move has overblown somewhat and we're going to see a significant reversion coming back into play. So let's get into the Movers and Shakers show, wrapping up the big moves within January as we move into February. So in terms of the big moves over the course of January for the indices space, you can see overwhelmingly a positive month. And certainly there was a lot of optimism coming into this year. There have been some major question marks at the back end of last year where you're saying October is always a bad month for markets. November is generally a bad month for markets when there's a US election. And when that's out of the way, it's going to be great. Donald Trump comes into power and everyone says, great, we've got this pro-business president coming into the White House. Everything's going to be brilliant in terms of equity markets. Well, certainly February has pointed towards something a little bit different at the beginning of it. But January was all about market strength, market optimism, and heading up that was the DAX. And it's an interesting one because the German economy is still in the doldrums. We're not necessarily seeing a massive resurgence in terms of the German economy. But this is where we see that the stock market is not the economy. The stock market, the DAX, continues to power higher, led by the fact that we have weak economics and weak inflation, signaling that the ECB can just continue to cut rates. And that's not necessarily the case everywhere. We're seeing a more patient approach from the Bank of England, despite the fact that we're expecting to see a rate cut this week. We're seeing a more patient approach from the Federal Reserve as people are thinking, are we going to see 1 or 2 rate cuts this year? That's not necessarily the case with the ECB. They're front loading these moves. They're cutting interest rates in an aggressive manner. And that has benefited businesses throughout the region when it comes to their valuations on the stock markets. On the bottom end, we've got the Nifty, and the Indian market has been a relatively strong performer over recent years, but this pullback comes as a sort of counter trend move. So we could see a potential opportunity there to get long the Nifty once again. So let's look first and foremost at the DAX. So the DAX chart we can see here. Let's just throw it into full screen mode. So this is the DAX, right? So what have we seen in terms of that move for January? As is often the case, if you're looking at a snapshot, let's say on this occasion it's a 1-month snapshot, you're going to see the best performers as the ones where the beginning of the month started at a low, and then we managed to sort of peak out at the back end of the month. And it feels like it really aligned very well here. You can see that we're sort of flatlining for the second half of December. But then once 2025 kicked off, we just saw this big move towards the upside for the DAX. Now, of course, we're seeing some jitters coming into play over the past couple of weeks. We've seen the DeepSeek thing, which has just provided some AI jitters globally, really. It's not necessarily got major implications for the DAX per se. And then we saw the sort of tariff news coming into this new month, and that provided the gap lower. Key to that is the fact that we've now seemingly found a short-term resolution between the likes of the US and Canada, the US and Mexico. We're now looking towards China and saying, you know, we're going to see the same kind of thing. There's talks of a discussion between Donald Trump and Xi Jinping. And certainly as these things get taken off the table, albeit temporarily, it does provide a bit of a relief rally. But we still have Donald Trump saying that he's going to target the EU, and Germany, when it comes to goods exports, Germany is probably going to be the one area they're going to look at and think they're going to get hit hard if we see tariffs imposed and maintained. That is a big if, because by and large, it seems like these tariffs are aimed at bringing countries to the table rather than a long-standing solution. But certainly, you know, you're talking about a highly reliant economy on manufacturing and exports of goods rather than services. And that means that the German economy and the German DAX is likely to come into the spotlight. You've got to say, you know, we've come off the back of this strong run up. We've pulled back into this 20-day SMA, which is the middle Bollinger Band. If we look at previous instances, you can see a sort of split between those times where we rebounded off this middle Bollinger Band. You can see it once again here and here. So it has provided support in the past. And then those occasions where it moves beyond it and into the lower threshold of the Bollinger, and that marks the low. You can see here we sort of rotated around that lower Bollinger Band for an extended period of time and then moved higher. And then we pulled back here and came within touching distance and moved higher. At the moment, we've just come into that middle Bollinger Band. We've actually got a very wide one as it stands, but it's tightening as we're sort of consolidating over the last day or so. But certainly at the moment, we've tagged that 20 SMA. Certainly, I would see it as being key as if we see that breakthrough 21079. If we do so, you're looking at a little head and shoulders formation, the potential for a move back down into the lower end of the Bollinger Band, which, like I said, it's climbing. So this is a dynamic line, but it would point towards a wider retracement of that rally that we have seen recently, which is, I mean, probably if you want to play it safe, you'd be looking at the wider move here. So, you know, if we're looking at sort of 61.8 would be 20460, you know, would that line up with the lower Bollinger Band? Maybe, you know, 20400 kind of area looks interesting. But then, like I said, you know, we've also got the potential to sort of draw your fib from this point as well. It really depends on how you're utilizing it. And then you'd be looking at, you know, this kind of area here, 204, 205 kind of area. But that really comes down to if we break that neckline as is shown on the 4-hour chart with 21079. As things stand, we've rallied, closed that gap pretty much. And so there is still a chance of some weakness. I would say we've run quite heavily towards the upside. There's going to be talk about US-EU trade relationships breaking down. Germany's at the forefront of that. And therefore, you know, the outperformance of the DAX, I wouldn't be surprised to see it sort of underperform a little bit as we move forward in the near term. Now, this is the Nifty. And like I said, you know, you're looking, this is the weekly time frame. You're looking at a great performer over recent years. And we do have these periods like this one here, like this one here. You have these periods where it's sort of protracted consolidation, retracement mode, and then generally it then picks up once again. Well, crucially, we've come back into this trend line. You can see 1, 2, 3 touches into this latest low. From a fib perspective, you can see we haven't necessarily hit a fib per se, a notable fib, and respected it. We've come into the sort of middle of the deep fib retracement zones, but a deep retracement zone nonetheless. And so this trend that we've been seeing over the past 4 years still remains in play on the weekly time frame. The key low is 21281. We haven't hit that. We've instead pulled back into this trend line support. We've respected it very well. And as we move through the timelines, you can see here that we've got this near-term swing high that needs to be taken out, which is, I've got this on the wrong side. Let's go to the right. There we go. So 24226. That's the key swing high that if we break through it, then this pattern of lower highs and lower lows is done and the bulls are well and truly in charge. Until that happens, you have still got question marks about whether this is a retracement within this near-term downtrend that's been playing out over the past, say, 5 months, something like that. And so we'd be looking at this and saying, is this a retracement? So we've got past the 50%. We've got past 61.8. So we've only got the 76.4 fib left. So that means, you know, as you move through each fib, you grow increasingly confident that this isn't a retracement, that this is a bottom. And given that wider trend, and certainly if we see the US sort of casting aside those sort of tariffs and the potential breakdown in global trade and global growth, then, you know, that is beneficial for this market. And there's a good chance that we have bottomed out here. So whilst we've seen the DAX outperforming and gaining like 8% over the course of the month, we've seen the Nifty moving towards the downside. And arguably, I wouldn't be surprised to see that relationship flip because the Nifty looks primed. If we're looking for a move back up to the prior high, you're talking about a sort of 10% move towards the upside. Of course, this is a weekly time frame. So you've still got, you know, it takes time for these things to play out. But I think there's a good chance that we do see the Nifty coming back into favor before too long. And this could quite easily be the bottom, having retraced back into that trend line support. Next up, let's talk about the FX space. So here are the FX movers. Of course, when you're talking about percentages, we don't necessarily see the same kind of scale that you're going to see on many of these other markets. It's also relevant to note that, you know, these are the sort of indices. So the Japanese yen index, much like you've got the dollar index, these indices can be found. And it's a way of looking at the currency against a basket of other currencies. So if you're looking at the sort of top performers, the lowest performers, you're looking at, say, the Japanese yen on the top end. Why is the Japanese yen outperforming? Okay, so there's a number of reasons why the yen is doing well at the moment. For one thing, we're seeing a resurgence in terms of inflation pressures, resurgence in terms of wage pressures. That points towards the BOJ needing to raise rates once again in the near future. At the same time, you're seeing question marks around the US dollar as a haven, given the fact that we've got everything that's happening in terms of tariffs and a breakdown in trade and the potential implications for the US economy if the likes of the Mexicans and the Canadians and the Chinese were to simply retaliate and not sort of bend over and bow to the demands of Donald Trump. If we see that breakdown in terms of trade, then the natural move towards a haven might not necessarily be the US dollar. It might be something like the Japanese yen, certainly at a time where we're seeing the BOJ cutting interest rates. On the bottom end, we've got the pound, we've got the Canadian dollar. The Canadian dollar, which I mean, I've got on the bottom here, but they're equal. You know, the Canadian dollar, of course, it's been hit hard because we've got these question marks around the breakdown of relationship with its number one trade partner just over the border. You've got, you know, that potential breakdown with the 25% tariffs has significant implications for the Canadian economy, much bigger than for the US economy. Of course, the US is much more diversified in terms of its trading partners and a much bigger economy. The Canadians heavily reliant on exports to the US, in particular, the likes of oil and gas. And certainly with Donald Trump also targeting that sector, it's bad news for the Canadian economy. And of course, that means it's bad news for the CAD. So let's look at, first and foremost, those two currencies set against each other. So supposedly the best against the worst, and this is exactly that. So from a weekly time frame, it looks like this, right? And this is generally quite similar to what you're going to see for many of the different yen pairs, because ultimately the Japanese yen has been hit hard over the course of the period where all the central banks were cutting interest rates. Apart from them, they were looking to raise rates soon enough. Where all the central banks were, the central banks were cutting rates, the BOJ were raising rates. And we're at a position now where the others are moving rates in an opposite direction to the Japanese. And we're seeing the potential for the Japanese yen to come into strength. So what's happening here is interesting because we're seeing this resurgence take hold. But instead of creating that higher high, we create this lower high and now the lower low. So there is a prospective top in play here. Notably, if you're looking at head and shoulders formation, this isn't the kind of head and shoulders formation you ideally want, right? Because you want it at the top of a trend. So it's almost sort of an exhaustion move. That's not what's happening here. It's come at the bottom of a sell-off, right? So it's interesting, but ultimately it points towards the importance of the creation of highs and lows and the order of that. And certainly at the moment, we have created that lower low, but we're rebounding at the moment with that Canadian agreement with the US. So that us to sort of breathe a sigh of relief for a month. But bear in mind that the talk was all about a border and all about fentanyl. It wasn't necessarily about the imbalance of trade. So nothing's been done in terms of rebalancing trade. There's a good chance that in a month's time, Trump's just going to go back and start asking for more. So those question marks could quite easily resurface once again. We're rebounding. We have managed to, as we can see on the hourly time frame, have managed to tentatively break through this downtrend, having moved just about through this 107.72. So there is a possibility for further upside over the near term. And you know, you're looking at a trend that, like I said, you're going up and down and up and down, up and down. There's a good chance this is the low for the down, and then we move into a sort of upward phase as we recover through some of this month and almost gear ourselves up for these discussions to come back into play once again. But certainly, you know, this is something that if we do see it resurface and in a month's time, we find out that, okay, we're just going to pretty much hear about this every single month, that could put a dampener on Canadian dollar sentiment, because it means that it's just going to be a consistent story coming back in with fears around the direction of travel for the Canadian economy. And at the same time, we've seen rampant rate cuts from the BOC, and there's probably going to be more talk about rate hikes from the Japanese bank at the BOJ. So that's certainly one to watch out for when it comes to the FX markets. And finally, let's look at the commodity space. And the commodity space looks a little bit something like this. And it essentially shows that we've been seeing really big outperformance for the precious metals. So silver at the top, platinum second, gold third. incredible returns, quite frankly, especially for gold, because you talk about silver and you might see sort of major volatility over the years, but you don't necessarily see that kind of return over the course of a month for gold all too often, quite frankly. I would say, look, there's a number of different drivers behind why gold moves higher or lower. But generally, the theme that we're seeing at the moment in terms of the breakdown in relations between the US and a number of different key trading partners, or not even major partners, right? So if you're looking at potential adversaries and the whole de-dollarization story with the BRICS nations, we've seen huge stockpiling for those BRICS nations when it comes to gold and precious metals. And that means moving away from US treasuries, moving towards gold. The more that the US breaks that relationship, the more people, I think, or countries are going to move into gold. And by a proxy, silver goes with it, right? Generally, gold and silver trade at periods where when gold does well, silver does even better. When gold does poorly, silver suffers even more. It doesn't always play out absolutely perfectly. It's not to say every single day that gold's up 1%, silver's up 3%, because there's often, a lot of the time where silver just lags and lags and lags. And then at some point it'll play catch up and it will spike well beyond where gold's at. So silver's outperformed at a time where gold's performing well. That makes a lot of sense. On the bottom end, we've got the natural gas story. There's a lot to this, and key to it also at the moment is the fact that China are looking to put tariffs on the US LNG, so liquefied natural gas. It comes at a time where you've got the possibility of Donald Trump maybe striking a deal to end the war in Ukraine, and that would suddenly open up the network for gas once again. Of course, Europe has been at the forefront of this position where they aren't really in a great situation in terms of getting gas, because what they have been doing is essentially continuing to take Russian gas and supplementing that with LNG from around the world. They've been keeping the stocks relatively high over the course of recent years. Now, what's happened is that the Ukrainians have essentially closed that pipeline from Russia. And so there's very little gas coming from Russia into Europe now. And what happens in Europe means that they then have to demand from around the world. And so it increases the demand for LNG shipments and it raises price. Well, what would happen if we were to see a resolution to this war? It would likely drive down gas prices quite heavily. And we did see that over the course of January, as people are perhaps speculating on what might happen between Donald Trump and President Putin. In actual fact, we haven't seen much, quite frankly. He hasn't necessarily said that they're on the cusp of making a deal. He said he was going to resolve it in 24 hours. Once again, that's not necessarily something that's true. But let's just jump into it. We're going to look at silver first and foremost, and then we can look at natural gas. So this is the chart for silver. Let's go onto the weekly time frame first and foremost. And so this is it. So I always try and sort of show you a chart from a relatively clean perspective, and then we sort of go from there. It gives you a good idea of how you can quite easily formulate decisions and expectations for markets without necessarily having spent ages looking at it and putting together the analysis. So first and foremost, we look at that wider context. So this is the weekly time frame for silver, right? So are we bullish or are we bearish? Well, we should have been bearish throughout that, flat during this, and then we're now in a bearish phase. So within this bearish phase, you're going to see major chop, right? So you see big up phase and then retrace it, big up phase, protracted retracement, up phase, retrace, up, retrace, up. This is the retracement, right? So are we looking at a deep retracement? Yep, it's a deep retracement, almost to the 76.4. I mean, look, you could probably draw it from there, quite frankly, but one way or another, ultimately, I think it's a good chance that we've bottomed out here. As we move in through the time frames, you start to look at the shape of that retracement. This one's a bit of a funky one because we've also got this blip, but essentially you can take this as A, B, C style retracement, which is part of the sort of Elliott wave theory. So that's often how those retracements take hold. 1, 2, 3, and then you move back on to the bullish trend once again. Confidence comes when you take a break up through that first swing high. On this occasion, let's get this to the right. There we go. It's 32.32. So what do we need to tell us that the bulls are back in charge to the point where we're going to break up into that prior high? We'd need to see a break up through that swing high. What would be the precursor to that happening? If you wanted a sort of early signal, it would be us moving through all the fib retracements, because it means that it's not a retracement essentially. And that's what has happened now. We've pushed through the 76.4 fib. And so there's a good chance that we are going to continue to move onwards and upwards. Over the sort of near term, we've seen this volatility coming into play. And this really does highlight, when you're talking about tariffs, when you're talking about the implications for precious metals and gold and silver and the like, right? People might say, well, it's a haven, so that means if markets are selling off, then gold and silver are going to do well. That can be the case, but it can also not be the case, right? So I can tell you when it won't be the case. When markets are selling off across the board, people will sell their gold holdings because they might be getting margin called across a number of different positions, and they need to try and get some funds, and they'll take money out of their profitable trades, right? So that's one way why someone might get out of a gold or a silver trade, even when markets are selling off, instead of perceiving it as a haven. Another way that you can see it doing well when markets are selling off is if people think that suddenly you're going to see a rampant shift in terms of the monetary policy outlook. If markets are selling off or the economy is weakening to the extent where we think we're going to see a huge amount of rate cuts or quantitative easing from the Federal Reserve, that benefits the likes of silver, the likes of gold. So it's not one size fits all. On this occasion, we saw that sell-off at the beginning of the week, and we've been recovering since. And like I said, I think that precious metals benefit from the potential breakdown in relations between some of these countries anyway. And if you're going to move away from the US dollar, one way to do it without necessarily risking a kickback from Donald Trump and the like, instead of saying we're going to try and buy and sell all of our commodities like oil in currencies other than the US dollar, where you can just stop buying US treasuries, you can buy gold instead. And he can't force you to buy US treasuries. That's your decision. And we have been seeing that. We've been seeing a move away from US treasuries towards gold in terms of treasury assets. And that benefits the likes of gold and silver. So I am bullish for gold and silver. We're moving towards the upside. We've moved through the 76.4 fib. We're heading back towards within touching distance of this recent high of 3173. And beyond that, we're looking up 3232, which is the high that we have right there as we move towards that 3488 high that was established back in October. But for me, we've got a bullish trend. We've retraced pretty heavily. I think there's a good chance that this is the beginning of that next phase towards the upside for silver. And then finally, wrapping things up with natural gas, let's look in terms of long-term perspective. So this is the whole Russia debacle. This is Europe trying to keep a lid on prices. We've been rising up through that prior high to the highest point since 2023, as Europe is essentially having to find gas from elsewhere with the Russian supplies by and large all done now. But like I said, there's a lot of sort of speculation over what might happen in terms of that war. And if we did see the end of that war, then that's going to be downside for gas in my mind. Of course, we've also got this talk of Donald Trump, drill, baby, drill. Well, that's going to produce a lot of gas and oil if that happens. So we've rallied towards the beginning of this month on this talk of a breakdown in relations with Canada. And are we going to see a spike in terms of oil prices off the back of that due to lower supply in the US? Potentially, but we're starting to roll over. So, I think there's a good chance that for the time being, we see as the US-Canada relationship remains on a decent keel, then maybe we're going to sort of consolidate a little bit. I don't necessarily see a massive spike coming unless we see a breakdown in that relationship. And of course, we'll be looking at that US-Russia thing, but I don't necessarily think we're going to see a major breakthrough on that front. So, I guess the question mark then is, how are stockpiles looking in Europe? And I would say, look, we're at the back end of the winter season. We can see the end, the light at the end of the tunnel. And that means that we're probably not necessarily going to see a major squeeze in terms of demand, which would likely see prices spike, which is exactly what we saw in the past. We're desperately trying to find the gas before people have to start turning off their lights and the like. And they're heating. So I don't necessarily see that coming. We're at the back end of it. But certainly there's some question marks around it, and any developments when it comes to the US-Canada relations, any developments when it comes to Russia and Ukraine and the war there, that's going to have a significant impact on natural gas going forward. I hope this has been useful for you guys. Make sure to like and subscribe for more content from myself and the Scope Market teams. My name is Josh Mahony, Chief Market Analyst. Have a great day trading and have a great month, because we'll be wrapping up in the same way in a month's time as we look to February.